Tariff talk has more bark than bite. That's what Tom Lee says about the tariff talk right now. Let's listen to what he's got to say. Don't worry about subscribing, tapping the like button, or looking for the coaching and Discord link. Let's dive into what Tom Lee has to say about the market right now.
Does take us to our talk of the tape. The markets, according to Tom Lee, that is, Fundstrat's managing partner, head of research. He is with me here at Post 9. Welcome back.
Good to see you, Scott.
I said, so as you miss, inflation expectations spiked. You've got more tariff talk from the White House. And then I saw a report, too, from Jake Sherman, Punchbowl News. $4.7 trillion tax plan is what the Republicans are said to be discussing. I thought the market took a little bit of a move lower on that as well, just given where rates are, concerns about the deficit, et cetera. Your thoughts on all three?
Well, you know, it does seem like a pattern in 2025 as markets sort of take a hit on Fridays and maybe panic Monday. So I don't know if that's going to be the case. To me, I think the inflation headlines from UMich they're not great to see, but also I think that they are messed. Or there's a political component to this because if you break that down between Democrats who see 5% inflation and Republicans at zero, the blend is actually pushing this number up, but to me, it just gets messy around elections.
Yeah, but I mean, let's be honest. There are broad concerns about parts of this agenda from this White House, including, I might add, from the Fed, that it could be inflationary when rates are already more elevated than I think the Fed would like to see. They'd like to be able to cut more, but their hands are tied. And one of the reasons their hands are tied because of tariffs and unknowns about inflation. Fair?
That's fair. I'm not sure the UMich survey reflects their assessment necessarily of the tariffs as much as, let's say, the bond market. And the bond market seems less concerned about it because, as you know, yields have backed off from 4.8 towards 4.5. But you're right. Tariffs are a reason to be uncertain. But so far, I think if I looked at how markets reacted, I think they've actually taken them in stride.
I mean, your biggest takeaway thus far, you say, is that the market's proving resilient, which, I mean, let's be honest, too. Since the start of this bull market, it's been one heck of a resilient market. It's been able to deal with almost anything thrown in its face. You've had a couple of panic moments. Monday off of the tariff news, last August with the unwind of the carry trade, and then we just continue to set new highs.
That's right. And I think in 2025, a lot of investors thought maybe the playbook would change because we just put 20% years behind us. But I think with January being up 2.7%, and I think these sell-offs being bought, it does feel like the same market that we had last year.
What are you worried about?
Well, I'm worried about sentiment becoming too bullish, but actually
too bullish?
But it's turned the other way. You know, sentiment actually has weakened pretty meaningfully. And I'd worry about a policy error from the Fed. And as you know, the bond market still thinks there's more than a 20% chance the Fed hikes this year. I think it would be obviously a policy error if they raise rates.
What about a policy error from the White House?
That's also something markets worry about, yes. But so far, I would say that the news that we've seen on tariffs, they've had more bark than bite, meaning they've proven to be opportunities for investors to buy.
What would you buy?
Well, the big news this week in our minds is the ISM moved back above 50. That really does point to earnings dispersion improving. So I like industrials, you know, the financials. I mean, the small caps, which have been, you know, not a great outperformer yet, but we still think small caps are going to do well this year.
What happens if some of the uncertainty around D.C. and policy has a more negative impact on not only sentiment, but actual transactions? I saw a stat today that M&A is off to an incredibly slow start this year, when part of the narrative coming into this year was animal spirits. Can't tell you how many times I heard that phrase over the last 3, 4, 5 months. And What if we don't get that?
I mean, it's still too early, right, because we're only 1 month into the year. The recovery in optimism, both in the NFIB and even the ISMs, I do think it would sort of argue CEO confidence should be better. So I would expect M&A.
We had all but one of the mega caps report. We got to wait a couple more weeks for NVIDIA. What's your takeaway?
Well, it's been a good earnings season so far. The Mag 7 as a group hasn't been great. You know, in fact, they've been a drag on the S&P this year. So part of it is it's telling me I think a lot of good news is baked into some of these names, and especially with CapEx going up. But it doesn't mean I don't think they're market performers. I just think the outperformance this year comes from financials, small caps, industrials.
Canaccord Genuity today on the Mag 7. We think it's fair to say this has been the softest quarter for this group collectively in the last few years. Is that a meaningful softness, that maybe the best times for a while are behind it?
Well, and that's a relative term, right? Because on an absolute basis, these companies are growing far faster than the S&P. But from a, what's priced into the stocks, clearly it wasn't a market surprise. That's why year to date they haven't been great.
What about you're paying up, in some respects for declining revenue growth, especially in key areas like cloud for some of these players where that's an essential part of why you were willing to pay up in the first place? Does that matter?
Well, these are secular stories. So to me, stocks might actually underreact to earnings and they might overreact to earnings over time. And, they may consolidate for several years. But to me, the key drivers for why you want to own the Mag 7 haven't changed.
Seems like these names have sort of separated themselves from each other. If you look at a chart, for example, of Meta, it's been magnificent. It's like the Magnificent One.
Well, you heard what Tom Lee had to say, and I told you one of the big things about the market was the 10 and the 2 yield, and the 10-year bond being at 4.7, 4.8 is very high. And I told you guys in a video several weeks ago that if the 10-year bond fell back to right around 4.5 or 4.4, it'd be a lot better. And the market did go up as the 10-year bond was going down. The tariff talk cooled off as it got delayed 30 days. Things looked like they were getting better, and now the market continues to act in a weird way. Microsoft beat earnings, but the guidance wasn't strong enough, so kind of dipped. Tesla missed earnings, and it kind of consolidated, but yet went up. But then, when there was some protesting on Elon Musk and some negativity around him, the stock started taking a nosedive. But not only that, AMD beat earnings. However, their revenue, even though year-over-year growth of 69% on server data, it wasn't as high as expectations. So it started to go down. Apple also came down. Ford, GM came down as well. A lot of stocks on earnings came down. And Palantir continues to rise and absolutely dominated earnings, just like Meta. In my opinion, Meta, Palantir, Microsoft, the strongest three stocks right now. The Republicans believe we have inflation at 0. The Democrats believe that it's more roughly around 4%. In between would be 2. And there's always messy inflation data around elections and a lot of political, I guess you could say, tensions. Tom Lee said that the tariff talk has more bark than bite, and I would agree. And we've had 2 years, the past 2 years have been 20% gain each year, 2023, 2024, and it looks like we're headed into the same type of market for this year, Tom Lee said. Although Tom Lee is a little bit worried about the Feds, we have got some hawkish Feds that have joined the committee, and that's not really a good thing. There's a 20% chance that the Feds could hike the rates again. And although that's still kind of on the lower side and less likely than rate cuts, a federal policy error could cause the stock market to go in a little bit of a frenzy or turmoil, which is what Tom Lee was talking about. Although he's expressing because the ISM being above 50, it's just an opportunity to buy. We have PMI data that came out with manufacturing. It's expanding, and services forever expanding. These are opportunities to buy. The Magnificent 7 have been weighing in on the S&P 500 in a negative way lately, and this has been the slowest quarter collectively for the Magnificent 7 in quite some time. Although the fundamentals, Tom Lee said, have not changed on any of these stocks, and he's absolutely right. This is 100% a buying opportunity, in my opinion. I've explained this to you guys before. When stocks are at the bottom or near the bottom, like Tesla and Amazon, Apple, and of course Microsoft, which is at a bottom. I've got puts for sale, and puts at around 400 and 405 are the bottom. It's a discount price, in my opinion. But most importantly, we have some data that's going to be coming out this week. Jerome Powell speaks February 11th, 10 a.m. this Tuesday in the morning, and the market is waiting anxiously to hear what he has to say. And typically when Jerome Powell speaks and you have PMI data or inflation data coming out at the beginning of every month, the market will be rough on Monday and Tuesday morning. After Jerome Powell speaks, it could get a little bit better, most likely on Tuesday, just a little bit, and then it will kind of sell off or consolidate into Tuesday. It's usually what happens. Sometimes it runs, but it's more likely to consolidate or dip a bit. After we get data back on Wednesday, if it's good, we meet or beat expectations, the market typically runs. And so this signifies a buying opportunity for this Monday, Tuesday, and Wednesday. Look, even if you buy and the stock market goes down a little bit after Wednesday, it's going to eventually, in the coming weeks, go back up. February is very much known for being a poor month. January is not really a good month either, but March, April, and May are strong months and a lot better than February. And we just had the election in November. We had inauguration in January. We have a new president. Things are changing. Things are different. We have political tensions. There's a lot of things that have to calm down in the market right now that are a little bit edgy. And policy changes. We have the Feds. Are they going to cut interest rates? Are they hawkish, dovish? Are they going to raise interest rates? Although unlikely, there's still that looming possibility. So we have a lot of things to worry about in the market right now, but ultimately, Tom Lee explains that small caps are really good, and he likes the industrial stocks as well. Things like Caterpillar, J.B. Hunt would be good, Johnson & Johnson, SoFi, Bank of America, Verizon, Citibank, Ally Financial, American Airlines, Apple still strong, Magnificent Seven is still strong. These are good stocks, but I've also told you guys before, Grab is good and New Holdings as well. If you guys want to see the top 5 stocks that you need to add to your portfolio for March and the 2 top stocks you need to add to your portfolio right now for the next 5 years, comment below if you guys want to see that video. I teach my students this all the time: portfolio diversification, understanding how to diversify, how to spread out your money and put it to work so that you can make money consistently and safely in the market. You guys can see the profits on the screen that my students have been making. If you would like this to be your success story, I would love to help you. You guys can sign up at any time at investwithcorey.com. The link's in the information box below. And I would love to help you guys grow your portfolio and put you on the right track like I have done for all of my students. Remember, guys, when you see a sea of red during this week, right before the news, it's time to start getting ready to position ourselves and buy the bottom and buy the dip. When the news comes out and they meet or beat, start adding positions to stocks that you want in your portfolio, selling puts for safe, consistent, passive income. But ultimately, right now, we have a strong market ahead of us, and the data coming out this week is mainly to blame for the dip that we had this previous week. And of course, we have the looming issues of tariffs, although, like Tom Lee said, more bark than bite. But I ultimately think we're going to have a pretty good year for 2025. Remember, no emotion and no fear and greed in the market. You got to turn the psychology off and just look at analytics and data and trade with strong fundamentals and understand that what goes down must come up. I'll see you guys on the next upload or video. Take care of yourselves, fan. I'll see you on the next one.